Today we are discussing, it's a little bit controversial, John, this div or division 296, and it's the proposed tax on superannuation balances that are over $3 million.
Which most people think that's a lot of money.
It is. What's it like to have that much in your super,
I would
John?
not know, but I do hear a lot of people around the country are not happy with it.
Yeah, and that's what I kind of want to get into, because I want to take people through the details, how it works, how it's calculated, a bit of the history of it, has it been tried elsewhere, and we're really just going to, unpack it.
Yeah, I'm going to strap in for the ride. You're going to lead this thing because this is your baby.
That's right. So if you are watching on YouTube, you will see the presentation that I've got. Look, you probably will be able to listen along if you're listening on the podcast app or on Spotify, but we did want to make this visual as well to explain to people. But if we go now, and John, jump in along the way. John Pidgeon, of course, hosts the This Is Property podcast, which is also on YouTube. It's got its own channel. But let's start by saying we are recording this on the 28th of May. I did want to date stamp this episode because this legislation, it's still in play. It's in the Senate at the moment, and it may get amended, it may not, but we just want to say that there could be changes by the time the Senate reconvenes in a few months' time. Right. So I'll just say that. So what is Division 296? Well, it's scheduled to start on the 1st of July this year. So I would imagine the Senate, they're not meeting again before this date, but it'll probably, if it gets passed in its current form, we'll have a baked-in start date of 1st of July 2025.
Yep.
As we said, it applies to individuals with a total super balance, or we'll call it the TSB, of over $3 million. And it means over the $3 million in super, it's effectively a tax rate of 30% on earnings. However, there is a however there. There's some interesting ways that they do calculate that. So the 30% is made up of the 15% internal super tax rate that's already there.
Yep.
And then they're just applying a second 15%, so a total of 30%.
Yeah. So it's an increase, essentially 15% is what you're saying, but collectively it's 30 overall.
Yeah, for those balances in superannuation over $3 million. It applies to all APRA funds, which are your industry funds, your retail funds, self-managed super funds, and exempt public sector schemes. And it's not a cap on superannuation. It's literally an additional tax. So we want to flag that. How much will it generate? So Jim Chalmers, the architect, they're pricing this in at $40 billion over 10 years. And it's important to note, John, that this applies to approximately 0.5% of all superannuation balances in Australia right now.
Which is pretty minor overall, isn't it?
Yeah, and that's why there is that part where maybe we need to have a bit of a cold shower and chill out. But what I want to do is just kind of walk people through the mechanics of it. I want to also get your opinion. And just a reminder, like anything on this podcast, John, it's effectively a big opinion piece of both of us when we've got a microphone. So, but yeah, I was just adjusting some audio levels there. But yeah, so pretty much 80,000 Aussies have super at the moment with over $3 million. It's not indexed at the moment. So in the legislation that's proposed, it stays at $3 million. Forevermore, amen. A couple of things. Chalmers has put these costs. So, if we look at the government budgets, when we did the budget recently, the $40 billion over 10 years, say from this scheme, has been spent.
Yeah.
Okay, so it's in play,
Yeah.
and I think it'll just be a matter of formalities when the Senate reconvenes. Jim Chalmers has basically said he has said the indexation, future government will do that. And look, he's probably right. I'm not here to carry water for him. It's no different than other things over time where there's a federal budget each year. If the government continues to be lobby, like it'd be actually very easy for them to increase that. So I don't want to see this with fear or scariness. But
I suppose I haven't had anything like this within super in our time anyway. So it's actually, that's maybe one part of it. It's like, well, why are you touching my super? I'm putting it into super because it's a tax haven essentially. Now you're telling me I'm going to get taxed more on it?
Yeah, but you have to look back at the major super reforms in 2007 from the Costello-Howard government. Remember that year when they were changing to the contribution cap limit and removing reasonable benefit limits called RBLs, which was a confusing system. They had a transition period not to impact people negatively, where they allowed $1 million to be put into super on that transition period. So effectively, if you're one of the people that put $1 million into super in 2007, one, you're doing all right. Two, this is probably you if you're still alive.
Yeah.
And three, when we go through the actual numbers here, it's actually not as big and as scary as what it sounds like.
No.
And it won't impact as many people. And 100%, there is that one big elephant in the room. Do you know what that elephant is, John? And it's not me.
No, I don't know what that elephant is. So I think it's essentially taking from the rich to give to the government, to give to everyone else.
Yeah. And it's a broader question with society, right? Like every year when the federal budget happens, we as society demand more from the government. And that money has to come from places. The problem structurally, and I don't want to camp here, but the problem in Australia structurally, too much of the Australian budget is reliant on income tax. So that's just a comment. So the money has to come from somewhere.
Yeah, and there's always the argument that we're paying too many taxes and like you can go for back and forth for years, can't you? Say, well, okay, well, what are we doing with the money? Is it being spent wisely? Like, are we wasting money in different sectors? Like, there's a no-win situation, whatever you impose here, is there? Yeah.
So, look, I just want to say the elephant in the room is the whole notion, effectively, that as part of the mechanics of this, unrealized gains will be taxed.
Yeah.
So that's the elephant.
I've already got, say, another 500,000 of growth in my share portfolio or my property. As at today's valuation, I'm now getting taxed on that 500,000,
even though you haven't sold it.
It's just on paper as an asset.
Yeah.
Yeah. That's hard to swallow.
It really is. And there's a reason why they had to do it that way. And I will tell you as we go along. The reason why it does capture, I believe the main reason that it does capture unrealized gains is because you look at the biggest super funds in Australia, Australian Super, ART, which, they've paid us to advertise on the podcast. Aware Super, they've paid us to advertise on the podcast. I'm just disclosing this stuff as we go. Host Plus, Hester, Cbus. So you look at all these big funds in Australia. The way that they're worked, it's a unitized fund. So you might have $200,000 in your super account, and each unit might be worth $1.
Yep.
And we did another episode on Retire Right. Just look out for it, everyone. It's about wrap accounts, because we had to really explain how the super world works and the benefits of a wrap account, because it gets around this internally taxed unit price.
Right.
And you can literally save thousands and thousands of dollars a year in tax, but you just don't see it because it's in the unit price.
Right.
So if you need to take money out of your insert large retail super fund here, they have to factor in asset sales. They have to factor in income from those. So it's all to do with the super mechanisms that it's a unitized fund. So it's just easier to tax that unitized fund with an extra 30% all in one. Done.
Yeah, okay. So if that is the reason, and you got a seat at the table at the High Office, you've surely been told as to why the unrealised gains have...
Well, I did ask Katie Gallagher about it, and I think it was even on the budget podcast, the recording.
Yeah.
Like it was an on-the-record discussion, and she was like, yep, here's what it is type thing, because I think on balance they've looked at the numbers, and we've just talked about the numbers. It doesn't actually impact that many people.
No.
So while I'm not 100% categorically disagree, say this out loud, everyone. We are going to tax you on an asset that has grown on paper. What if it grew on paper that year, you got taxed on it, the next year it tanked, and then you sold it? Well, you've paid tax the year before on a gain that actually wasn't really there because it wasn't realised.
Yeah, but you're getting that back.
No, not if literally there was portfolio movement.
So okay.
And but just keep to the fundamentals. Yes, out loud, we are taxing assets, the growth of assets on paper, the paper value before. Like if I said to you, oh, John, you bought an investment property for 500 grand. It's now increased to 800 grand. Oh, that's 300 grand. You got to pay some tax on that. It's just outrageous.
No, it is.
But if we understand the super fund unitized units in a fund world, it's got to be factored in an easy way. And that's why I don't think they're going to come out the next week and say to everyone, all right, everyone, we're now taxing unrealised gains for your investment properties and shares.
Yeah.
Look what happened when they wanted to try and tweak franking credits.
Yeah.
Ask Bill Shorten what happened.
Okay, so that was my next question.
Yeah.
So individual stocks, assets that aren't in your large superannuation firms don't apply. Is that what you're saying?
No, the principle still applies
Yeah.
in the super funds, but it's just like this big chisel. It's like the interest rate lever. It's like just this big blunt thing where it probably works most of the time.
Yeah,
but
okay.
There's going to be things where it's but that's all we've got.
This is not fair for me. So if in your example, the 500K property goes to 800, I'm paying unrealised gains on 300K. I then sell it next year for 700. Now what happens?
You don't get the tax back.
Can't see how that's right.
This is the problem. This is the exact problem. 100%
And
it's cooked.
That's about to be passed.
Yeah, for super balances over 3 million.
Yeah, but
you've got to, yeah.
How can you pay a gain unrealised and then not be able to offset the loss if there was one on the gain that you've already paid? That doesn't make sense to me.
Yeah, but this is why it's pretty cooked, but it's all designed around the unit price I believe anyway.
Well, there you go.
Or
So-
look at it the other way. We've got 80,000 Aussies
Yeah.
with tens and tens of millions, billions and billions and billions. You're getting a little bit yippy, John. In super, they're going oh, stuff that. Who cares? We can tax them and they can pay with money outside super. Who cares?
Yeah, because they've got enough to go around. That's what we're saying.
Yeah.
And there's a portion of that I'm actually okay with, right?
Yeah, exactly. If you step back, superannuation, we don't want it to be just a tax haven for the rich.
No.
And by rich, I'm talking you got a net worth of over $200 million.
Yeah, the 0.5.
Yeah. Insert your definition of rich. There would be people who listen to this who say, oh, if you earn $300,000 a year, you're rich. Or if you've got a net worth of $3 million, you're rich. Sure. I'm talking in terms of this kind of discussion, I'm talking the rich, maybe $100 or $200 million net worth, big family offices. Yeah, come on. You're taking the piss a little bit, but they're playing to the rules. So this is the circular logic, isn't it? It's like, it's cooked that we're taxing unrealized gains, but I don't think it's a huge issue, and I 100% would believe that any future government would not apply that to assets held outside of super. Unless, and this is... So that's the biggest reason that's cooked.
So you think this is just the starting place for future?
Well, people will say it's a slippery slope. There's a slippery slope argument. I don't think it is. I hope it's not. But if you've got $3 million in super, you'll be okay.
We will, yeah.
But the principle, should we be taxing gains that are unrealized? Probably not. How else do you do it with unitized funds and,
But maybe it is for unitized funds and nothing else.
Yeah.
I don't know.
Or it's just literally this is how we had to do the calculation, because as we've seen in the example, it's kind of a rolling year. So what was the balance on 30 June last year? What's this year? What's the difference? So it's not each year. If 1 year you had 3 million and 10 years later you had 10 million, they're not, in the 10 years later, they're not going, well, the difference between 3 and 10.
No.
They're doing the difference that financial year. So
yeah.
That's what I mean. Like it's cooked a little bit that we're taxing unrealized gains. I don't love that. Will it impact the average bear? Well, that's what we're going to talk about right now in our case study. Hey, it's Glen here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.